Good afternoon and welcome to the second event in the British Chamber of Commerce's Leadership Forum. My name is Sarah Speed and I am Chair of the Financial Services Group. The forum this year is a series of events hosted by the different working groups at the British Chamber, examining the theme of building a sustainable future. Yesterday, following an introduction from the British Ambassador, we had a fascinating talk from Deloitte on the impact of ESG on business taxation. Next week, we have more events culminating with an in-person event at the Chambre de Commerce on Wednesday evening. Today, the Financial Services Group is delighted to welcome a distinguished panel of guests from the world of banking, insurance, and alternative asset management, and they will be providing insights on how we are collaborating to meet those sustainability goals. I'd like to thank Domus and Lux Dates for sponsoring the forum, and also Delano, who is our media partner. Don't forget to use the chat and the Q&A function to send us your questions, and I'll be happy to share those with the panel towards the end of the session. Now I'd like to hand over to Aaron Grunwald, Senior Finance Correspondent at Delano, who will be moderating today's session.
Thanks, Sarah, and thanks to the Chamber for giving me the chance to participate in this chat. Well, let's introduce our panel. We have Antonis Anastasiou, Managing Director of Domus Management Company and a member of the ESG Committee. He's here in Luxembourg. We also have Cristina Boscolo. She's Director of Wealth Structuring Solutions at Lombard International, also here in Luxembourg. And Caroline Haas, who's Head of Climate and ESG Capital Markets at NatWest Markets, and she's joining us from London. Antonis, Cristina, Caroline, thank you very much for joining us. The title of this panel is Walking the Talk, Are Financial Services Meeting Their Sustainability Goals? So let's jump right into it. What is your company currently doing to reach its sustainability goal? Antonis?
Yes, hi Aaron, thanks for that. I think the first thing that we actually had to do was really go through the learning process. We needed to understand, especially around the corporate footprint that we had as an entity, and from that point onwards, slowly identify the different areas and KPIs to which we needed to address. So over the course of the last couple of years, there's been quite a significant push and drive to be able to see how we would be able to manage our ESG footprint as a group. A dedicated steering committee was put in place, and the task that was at hand was to really identify where we are and where we stack up. Obviously, there's some more easier ways to be able to look at things when it comes to HR matters and the social aspect around it and the governance aspect to it. But then when you start to look at the environmental piece, there was some real learning curves that we needed to find and see how we were able to manage things. And it all ended up towards the framework where we presented some of the main KPIs and findings that we had in our annual accounts of last year. It was quite a dedicated section in the annual accounts in regards to ESG, but then going on forwards from there, clearly what we're trying to do now is see where we can better ourselves, see where we can start to find areas that need to be developed. And I guess on a secondary piece, see how we can possibly assist our clients going forward in certain products that can be made available to them in regards to ESG.
Cristina, what's your company doing?
It's more than 2 years, I would say, that we started this journey, the ESG journey at Lombard, and I think that I can talk about this from two different perspectives, because we have the perspective of our clients, the services and the products that we are selling to our clients, and then we have the corporate perspective. And we have done a lot on both sides. As to the product one, which is the base of our activity, we are selling an insurance-based investment products. We have been in touch constantly with all our partners, asset managers and custodian banks, to be aligned as much as possible in this path. And we have been, of course, implementing the SFDR requirements in terms of disclosure. And we have also enhanced our offering to clients, because we are today basically making available some investment mandates that are classified as Article 8 mainly. We don't see many Article 9. And this is coming with some additional information that we have to provide to our clients in the contractual documentation. So this is a work in progress, because then we will be ready from next year to have ESG products and not just offerings. And from a corporate perspective, we put together a working group. The governance around ESG is very much elaborated in the company, because we have lots of working groups on different areas: investment, suitability, advice, product, advisor, corporate reporting, corporate citizenship. And every group has a committee, and then we have on top a steering committee. So what I can say is that we started using renewable energy in our Luxembourgish office building. We started using only electric car in our company pool cars. The company started also launching programs and initiatives for employees' well-being, in terms of well-being, in terms of inclusion and diversity. We have more than 40 nationalities represented in the company here in Luxembourg. So people coming from different places. So it's very important that also there are relationships built across the company. And then, as a last point, it's also important for the company to have a citizen, a corporate citizenship, meaning also being attentive and present in the social communities where we work and operate. And so supporting, sponsoring events at social events in the community.
Thanks, Cristina. And Caroline, the same question. What is your company doing to reach its sustainability goals?
Yes, good morning, and thank you very much. It's actually quite extraordinary to see what's happened over the last 12 months. And we've been very blessed as Alison Rose came in as the new CEO of NatWest Group. What she very much did is create climate as one of the main strategic pillars of the organization. And with that, obviously, one has really kind of mobilized both the operational as well as the sort of front office, the risk, and all the different elements and functions within the organization around that goal of reducing our own emissions footprint, but as well as supporting our customers along their journey, which obviously is going to be, quite a long journey for a while. But what is interesting, we've always put targets out with regard to our own mortgage book, that we aim to have an EPCC of 50% or above by 2030. We have made it very public that we would like to expect the oil and gas majors to have credible transition plans by the end of 2021. We've obviously put in place also limits with regard to the coal exposures that we have, and with the same intent of the credible transition plans, and then working through that. Now, obviously, the balance sheet of NatWest Group consists of a lot of mortgages, but also of the SMEs. And so really the intent is to support those SMEs as they decarbonize. We've also put out a target by the end of 21 to have supported kind of climate and sustainable fund and financing of 21 billion pounds. 20 billion pounds. We have achieved our target already and are now at 21.5. So I think that will be, a new intent. And I think it's also just shows where the organization is focused. The fact is that we are a principal partner of COP26, which will be in November in Glasgow. So yes, so lots going on.
Thanks, Caroline. I think one of the big challenges when you're talking about ESG is data. So I wanted to ask all of the panelists about the data challenges that they're facing. And what data are you finding difficult to find, incomplete, imperfect, and how exactly does that change how you take decisions? Cristina, maybe we could start with you about what data challenges are you facing right now?
Yes. Well, we have to consider that the product, the specific product that we are manufacturing and distributing is an insurance-based investment product, which is an insurance product which is characterized by a very sophisticated financial and investment component. But while we do so, we do it in a very open architecture model. What it means that through our contract, a client may have access to multiple investment options, investment mandates, external funds usage, etc. Right now, all the decisions and the definitions and the classifications of the investment mandates are taken by our partners, who are investment managers. We are working with more than 500 investment managers, okay? So far, it's up to them to give us the score and the classification of every single investment mandate. We use that, we do some monitoring, but it's not us taking the investment decisions. So because we delegate them to the portfolio managers. So having said that, in any case, our difficulties is that, yes, we have to rely in this phase on what are the data and the classifications and the scores given by the third-party asset managers, the independent ones, but we struggle in coming to an internal alignment, okay? And to give client a full picture, because we have many baskets that may have different classifications, because we know that all these 500 plus managers, they are using different tools. Some of them have made their analysis internally. They have developed a proprietary method. Others are using database. Others are using other tools, Morningstar, MSCI, whatever. So our difficulties is really to bring to an alignment and unify this data, because they are not comparable between them, because unfortunately, and this is the challenge, there is not yet a common playing field. So, and this is, I think, the big challenge for the European regulators.
And how are you dealing with that in your company? I mean, you're getting all these different formats and all these different data streams, and you have to synthesize that into some sort of coherent picture.
Yeah.
How do you do that?
Let's say that today we are lucky because we will have, today we are quite passive, let's say. Of course, we go hands in hands with our partners, the investment managers, and we do some monitoring, and we try to be aligned in the way we classify, also compared to the risk profile of the clients. The big challenge will be from next year, when we will have following some changes to the IDD directive, the Insurance Distribution Directive, we will have to produce ourselves a pre-contractual and post-contractual information, and then we will have to put together all the different sources and data that we receive from the different partners. So maybe the idea would be really to use ourselves a tool and a provider that will enable us to do that.
Caroline, what about in your field? What kind of data challenges are you seeing, and how are you managing them?
But it's mainly the criteria that are used to define an Article 8 as opposed to an Article 9. That's the main issue that I see. I think that I see that Caroline is nodding to you have the same probably experience. So there is the taxonomy today is not at the stage that is allowing to have certainty on how to interpret these rules. So this is the main obstacles.
And of course, you're referring to the EU's Sustainable Development Regulation. Just for those in the audience who maybe don't know what the difference between Article 8 and Article 9 is, can you very, very briefly and simply explain the difference?
An Article 8 is a product that is basically promoting environmental and social factors, but doesn't have them as an objective. While an Article 9 is, so the Article 8 is called light green, while an Article 9 is a dark green. It means that there really you have assets that are having ESG, or better, environmental and social factors as objectives of the investment. So it's not only a promotion, but it's really the objective.
Okay, good. Thank you very much. And Caroline, in London, can you tell us about the data challenges that you're seeing at NatWest?
I think data is the favorite word of the greatest challenge that we have here. And it's knocking in everywhere. I think this is, from a banking perspective, obviously one of the things that we've had to do with the stress testing is actually look at the emissions of our portfolios. And so with that, we've had to almost take a bottom-up approach, corporate by corporate, looking at that. Now, as you can imagine, the larger corporates, it's easier because they're already reporting to some extent scope 3, or at least, notable scope 1 and 2, which you can start to apply. The more complicated aspect is when we start to take it down into the SMEs, who obviously, it hasn't really been a necessity. And so as a result, they don't have that in their kind of BAU as well. And they're starting to realize that they really need to kind of consider this also for their whole financing journey, if you will, because obviously you have the banks lending, and then at some point you may want to grow, and then you may have some venture capital or private finance coming in who will need a similar information. And then if that company grows significantly, if they were to list, again, that is the information that is now starting to feed through the system. And that is going to be required not just by the equity investors, but also the fixed income public market investors. And so you can see how this chain is evolving. Now, that's one side of it, and that's where everyone is trying to measure the transition. And what does it mean for a company to be transitioning? What does their carbon footprint look like? And then the other factor is actually the physical risk, which is obviously the two types of stress testing that has been required by the Bank of England in the SS 319 guidance, and sort of the work that all the banks have been doing in the UK. Now, this isn't just in the UK. This is going to come to the European banks. The EBA is going to do similar stress testing in 2022. And so the banks are already starting to mobilize around that. There was a pilot that was kicked off with a handful of banks, and now it's obviously going to be expanded to a lot more banks. Now, there's the transition, but there's also the physical risk. And the physical risk will be things like flood data, drought, fire, subsidence, and how that is going to actually impact physical assets. And those are all the types of data that we're requiring. And some of that is like EPC data. And even though you think that these energy certificates should be quite easily achievable, there's sort of issues in the system where they didn't need to be updated. So for example, if you renovated your house, you didn't really need to go back and ask for a new EPC unless you were going to sell the house. So as a result, you actually have old data that may not be representative of the housing stock. Part of that is actually now getting new up-to-date data on those, if those have been really old in the system. So, we're trying to fill the data gaps. I think one thing I have learned though, and sitting in all these working groups on the data, we won't have perfect data for a long time. And I think we can't kind of be driven by the fact of perfect data. What we need to do is just start, and then, almost on a 6-monthly basis, go back into the systems and update and try to then get new data as it develops. The data is coming on stream quite quickly. The rating agencies or the providers, the ESG providers, such as MSCI, are realizing that this is now pretty a crux of the ask, and sort of see it in different levels. And the raw data, because so much of this also from an ESG perspective is very subjective, and it isn't like taking a balance sheet and taking the qualitative numbers down. It's actually reading through hundreds and hundreds of pages of disclosure to pick out the little nugget of information. AI is helping, but it's not perfect because the definitions are different. Different issuers will use different language to ultimately say the same thing. But even if you were to look at gender, for example, and I'm not just talking about climate, I'm mixing a little bit here between climate and sustainability, but every organization will have a slight different definition of what the levels of gender is. So what does senior management actually mean? What does CEO -1 mean, or CEO -2? The total population is interesting, but really what we want is actually to see where the granular levels of gender diversification is. And so there's a little bit of alignment having to happen here, or I should say maybe more appropriately, a lot of alignment. The auditors obviously are also working towards this. We've had GRI and SASB that have started to merge, so that as a result, the platforms start to come together. And then hopefully with that, the data starts to become more homogenized, and then makes it a lot easier for us all to use as we feed it back up through the system.
Thanks. Antonis, the same question. What data challenges are you facing, and how are you trying to tackle them?
Well, I think both Cristina and Caroline really brought up some very key points there. And the way that I'll try to bring this into perspective is a little bit from our entity, because obviously we don't deliver or build products in the same way that that both Cristina and Caroline might be doing. We're more on the service provider side, managing or administering the product. So it's a different kind of framework there. But then again, to what Caroline was saying, we needed to figure out from a corporate standpoint who we were and what kind of KPIs we were looking at and managing, etc. And indeed, the gender one, which is it's the easy one to potentially look at. If you look at it from a global standpoint, we had very good and very strong 50-50 numbers. But if you tried to break down, then you could see that as you were moving further up in the seniority, these numbers started to we're not looking that balanced. So throughout the course of the last couple of years, this is something that has been tried to be rectified, and today we've even come to certain levels, even at the top board level, all the way down to have really that equality at the level of both the management teams and the day-to-day operational teams. So that's clearly something that is quite important. And then that's just one of the measures that potentially you can look at. If you start to drill out to a lot of the different KPIs that you can be looking at, there's a lot of information that you need to source, manage, and how do you actually put that information in a way that makes sense? You can put it in a way that it makes sense to you, but it needs to be put in a certain way that really makes sense out to the world as well. And let's say the lack a bit of benchmark and the lack of bit of the available data and information that you can really utilize in order to be able to see that is where things become a little bit more complex. And from the corporate side, as a large global provider, if you take the other one, which is more the carbon emissions of the buildings and things like this, obviously we're not a large industrial provider. So we needed to go into the buildings that we lease and those kind of aspects to potentially see where we can manage a little bit that sort of carbon footprint. And obviously certain buildings were easy to get, newer buildings and things like this that actually monitor all of this information. But then other older buildings, for example, was much more complex, or were not even monitoring this kind of data. But indeed, what we did from that standpoint in certain buildings that we felt were not in balance, we did step away from those leases and try to find more friendly or carbon friendly leases as well. So those are the kind of things that we try to identify and then put in place. But then to Christina's point, what I do, for example, at the AFM level, we also act as the manager. And this is where Cristina says we send up or we produce those kind of ESG reports, but sourcing of data on quantitative is easy, but the bulk of it is really qualitative, and it's very, very subjective as to what it is that you think is the right aspect and how it is that you can take that data, score that data, and prepare something. And this is clearly where Cristina says that it makes their job much more difficult, because I can prepare something in a certain way that we think is right, but then overall, it can definitely be more complex to be able to manage and source and build. So I think today we're at a certain stage where there's a real need of certain benchmarks that we can say for different types of asset classes from a manager perspective, what it is that we can utilize to say, well, this is how you stack up and this is how you're able to move forward. I would say in the real estate base, in the real estate space, or the infrastructure space, or the environmental renewable, there for sure, that's you have more KPIs that you can look at that are more straightforward because they're linked to that sort of framework. But what about the private equity space? I mean, there it's such a vast space. It's different types of assets, different types of deals, different types of underlying. So how are you able to do that, or debt financing for that side? So we're not there yet per se, but what I will say to close is that 12 months ago we were very far away. Today we're starting to get and to see a lot of developments. So I think that it's very fast paced in the way that we see things moving today. So I really think that in the short term and in the short span of the next 6 to 12 months, things will start to develop. And obviously in Europe, we've been much faster. We've put in place certain regulations that have been implemented in 2021, whereas in other regions, we don't have those kind of regulations yet. So it's really balancing between there, but it is moving quite quickly, I would say.
Yes, actually, that's a good point, that Europe is maybe more at the forefront. Maybe we can talk a little bit about how ESG programs are advanced in Europe compared with in Asia or the US. Caroline, maybe you have a perspective, because I know you're working across those regions. Is there a big difference that you see when you're speaking?
Yeah, so I think absolutely, I would concur that Europe is at the forefront and has really been driving this agenda. And as a result, you've sort of seen kind of, various areas that have been influenced, affected. Ironically, I was recently on a different talk, and I think it actually started almost in Paris for COP21, where very much sort of the mobilization of this started in France. You had Article 173 at the time. And so really that started to kind of kick this thing off. And then obviously the EU took this one fully into its hands and started developing the EU taxonomy. Obviously then how that influences the EU Green Bond Standard, the eco labels. And now, to be fair, they've really moved beyond it being environmental, but actually focusing to what Maria was saying earlier, around Article 8 and 9 and how you look at asset managers is actually an ESG discussion. And that now feeds into the corporate disclosure requirements and is really kind of all interlinked. Now, it's interesting to see, we speak to the US investors, quite regularly. And if I think of my conversations with them 2 years ago, this was definitely not high on the agenda. And at the same time, it was sort of a little bit sort of, oh, do we really need to focus on this? There was definitely also, I think, a slight geographic tendencies that the two sort of East and West Coast were already moving at a faster pace than probably the middle part of America. Undoubtedly, things were held back by the administration. And I have to say, though, over the last 6 months, it is extraordinary to say the pace at which this is changing. The US investors are taking this on board very, very quickly. Many of them are creating their own scorecards, just like our European investor counterparts are, looking at respective, KPIs that they're now measuring the issuer by. And then, you see that also with the fact now that the US has joined the NGFS. So as a result, that is going to help also, I think, drive, because it was definitely a weak link that we didn't have sort of North American or US support around the table on these different topics. And that doesn't matter if it's the investor dialogue, if it's the banking dialogue, it's just, how to mobilize around the issue. And now you really feel that engagement. Now, I don't think you will see a US taxonomy. It's not the way that the system actually operates. However, what is fascinating is to see how many conversations we're having with these US asset managers around the EU taxonomy. They're not going to take it on board 100%, but they're taking a lot of that information and now sort of processing it for their own purpose. So it is coming together. And the other area, and very briefly that I'll talk about, is APAC. Again, if I were to think about the conversations I had 2 years ago to the conversations I'm having now, it has been a fundamental shift. And the Japanese are very strongly taking this on board. It was driven also by the Japanese Post-Pension Fund, very much GPIF, on how they started to think about not just green bonds, but more broadly about the ESG profile. And recently we did a survey with some of the Japanese insurance companies. I was bowled over how, the percentage was sort of over 60% who were looking at the decarbonization strategies of the counterparts that they're investing in. So you can see that coming quickly. And again, the EU taxonomy is being used as a tool. Again, it won't be taken 100%, but what applies will be used. So the work that the EU has done, should not be underestimated. The time and the effort that has gone into it, and the 500-page document is actually being, absorbed, if you will, in all around the world.
Just a reminder to the audience: if you have a question for Antonis, Cristina, or Caroline, just put it in the chat box, and we'll have time at the end for Q&A. Antonis, are you seeing the same thing when you speak with investors and or clients in the US and in Asia?
Well, I guess in Europe, we know that we love our regulations. We create regulations to review regulations. So that for sure, you'd expect that in Europe, it was the first ones that really came up with something that in the form of SFDR that we mentioned before, that was put in place early in the year. Now, clearly, you see a lot of traction, though, in how the regulators are reviewing things in the US. Certainly in the US, you see the SEC talking a lot about regulations and how potentially they might be looking at things going forward. And clearly, there's a standard that was potentially set, which can be built upon in the US. And Asia, for example, for sure, this might have not been the main topic in certain jurisdictions, but certainly in Australia and New Zealand, they have been far advanced in the way that they have implemented a lot of the criteria around how they manage their assets and how they manage their day-to-day when it comes to ESG. So where you might not have seen the regulations come out per se, and the first ones coming out from Europe for the moment, but clearly, I think in a very short period of time, there will be a clear alignment into how things will be looked at, and moving more to those, let's say, globalized regulations around certain aspects, because it is a phenomenon that affects all regions. And that's why going forward, definitely, I strongly see that more sorts of regulation will be put in place throughout all of the regions.
Cristina, would you agree with that?
Well, yeah, I definitely agree with what Carolina said, and also Anthony. US and Asia have been for a long time lagging behind, and this is a matter of fact. Now, as to the US, leaving aside the political approach of the former administration, but the regulations made some progress though, because for example, the SEC, the Securities and Exchange Commissions, published a report on containing recommendations in terms of ESG, a creation of the ESG committee and subcommittee. We have seen also the US commodity futures trading commissions that has come with similar reports, specifically looking at how to manage climate risks in the US financial system. And in this paper, there is a recommendation stating clearly the need to provide a taxonomy on climate risks. As the other panelists said, the European taxonomy will be taken as a model. Probably not 100%, but is the only model they can have, they have available, they can look at. So I think that Asia and US in particularly have been gaining pace in the last 2 years in their progress within the context of sustainability and ESG, but very slowly. But maybe my impression is that while in Europe, we like, as Anthony said, our regulations, complexity, lots of delegated acts, regulatory standards, different layers of regulation. And this is very much driving then the push of ESG. While maybe in these other countries where the regulators have not engaged early back in time on these conversations and on these topics, coming with some framework. Maybe the markets are driven more by the investors' needs. Okay, so maybe opposite to Europe, where we are very much pushed by the regulators. In those countries, you can see that is coming from the investor's perspective.
Actually, Cristina, something you mentioned a little bit earlier was an upcoming change to the insurance distribution directive, I believe. And maybe just real briefly, could you explain what changes are expected and what that will change for companies like yours?
So for us as an insurance company that is selling the IBIP, so the insurance-based investment products, it will be a big revolution next year when some changes to IDD, Insurance Distribution Directory, will come into force. They are expected to come into force at the end of the summer next year. Basically, what IDD will change, and IDD is for an insurance company, the Bible, okay? Because we based all our activities and the way we do it on IDD and the prescriptions of IDD. What we will have to do from next summer, probably, is to start collecting the ESG preferences of clients when selling our unit-linked insurance product. Today, we don't do so. We are not obliged to do that. And it wouldn't make sense to anticipate time because the current status of the legislation will not allow us to do that in a safe way. So it means that when meeting a client, the ESG talk, conversation, preferences will become a big part of the suitability assessment of the product. So this is very important. And it means that we will have to ask really to our clients to what extent they want to invest, and also specifically in which kind of investment. Again, Article 8, because there is a promotion of certain factors, or Article 9, where you have really ESG as an objective of the investment. It will bring lots of work, because we are getting ready now, even if we are still missing the details of this changing. So we are trying to second guess what will be the new questionnaire that we will have to provide to clients. Indeed, it will increase the pre-contractual and post-contractual information and the monitor that we will have to perform from our side. It's a challenge, but it's a big opportunity. It's a big opportunity for us.
And Antonis, I actually was wondering a little bit about Brexit, and if that's made it a bit more difficult to market to investors in the UK.
Well, Brexit has made it very difficult to operate in general for a lot of fund managers, not just on the marketing side, but we've seen a lot of managers who had their AIFMs, for example, in the UK, and a lot of large managers, they had to transition out of that model. So clearly there has been quite a few difficulties to be able to manage in regards to Brexit. But more specifically on the marketing side, we've created 2 markets now. So you need local products for local investors, and whereas you previously had the ability to have everything into one framework, now you need local providers to be able to enter into discussions with UK persons and individuals. You have European domiciled funds with European providers or service providers to be able to manage marketing into EU investors as well. So it's still quite unclear how things will progress. There will be, and we do believe that there will be at one point, a review as how that can be done. But for the moment, it's quite difficult and is being done completely separately by a lot of the managers in that case. And in regards to Brexit as well, there's a significant amount of additional difficulties that are arising, because you had a license before, whether it was the AIFM license or the MiFID license, which was applicable also into Europe. You can't use those licenses anymore. You have all of these individuals or sales individuals which are sitting in the UK, but they cannot now approach EU investors. So what kind of solutions are available around that? You need to rely heavily on your EU domiciled placement agents or EU domiciled AIFMs like ourselves, for example, which are able to assist in those kind of aspects. But it's definitely caused a bit of disruption for managers. And for the moment, no clear guidelines as to how things will be moving forward. So we're still waiting to see how things will develop, but clearly it's raised difficulties. We found ways that we can manage that, and we found ways forward, but there still is uncertainty whether those methods which are available today will still be available 12, 18 months from today. So there's uncertainty in the matter for the moment, even though we do have certain solutions as to how we can manage it.
Antonis, and maybe Caroline as well, are you seeing any divergence when it comes to ESG? I mean, does the UK government or any of the British regulators, are they planning to diverge fundamentally from the EU guidelines?
So, it's interesting. In many ways, the Bank of England was actually quite far ahead when we think about what was being done with regard to stress testing, and the banks and the insurance companies. And so in a way, I think this kind of always comes a little bit in partnerships, or somebody does one thing and somebody else does something else, and then you learn and then you move forward. And in a way, the Bank of England obviously is in very close discussions with the EBA as they start to roll out the stress tests in 2022. And so I don't, to be honest, I think every country will take different aspects that works in their own system. And it comes back to my earlier point about the US, that the likelihood that there will never be a taxonomy in the same way. The UK has obviously stated there will be a UK taxonomy, which will obviously again build on the information that has been created by the EU taxonomy and then amended slightly to the dynamics of the UK market. And again, I think it's also important to note, there are differences in legal systems as well. You've got codified versus case. So all of these things will play into how that is then actually implemented. But I think the topic itself is so global on all sides. Climate change cannot be mitigated on an individual country by country basis. This actually has to be done globally. And as a result, the information we need needs to be inferred globally as well. And so that's where the ESG part comes in, because ESG is an expansion of the climate, or the E pillar. And so, as the EU builds out its social taxonomy over time, that will then refer back. And at the same time, you look at the Green Gilt, who's actually included social co-benefits in its framework, which is one of the first sovereigns to do that into a green bond structure. So I think it's interesting. You have this kind of back and forth. I think I don't know if I'd call it divergence. I would call it probably more putting your own stamp on it for your own purposes and countries' needs versus kind of going completely in different directions.
You think it's a sort of healthy competition, maybe?
Healthy? Yes, I think everybody has the same common goal. And then obviously you're right, there is a little bit of competition, but that happens everywhere. I'm sure Antonis could say this in the corporate space, and we can definitely say that it happens in the financial institution space. It definitely happens in the asset manager space. So, everybody does want to have sort of their objectives or their agendas voiced ahead of maybe somebody else's. But this space is moving so quickly. I don't know if our organizations and the governance will always keep up with the statements that we want to be making. But no, I think that it is healthy.
Excellent. Well, I did have another question, but I just wanted to check in with Sarah to see if there are any audience questions, and there's still time if you have a question for any of the panelists or all of the panelists. Just go into the chat box. And,
yes, so we did have a question earlier. Is nuclear an area of contention in terms of investment assets? Perhaps something that Cristina or Caroline can comment on. You're on mute, I think, Cristina.
Voilà. So what I can say is that indeed the discussions over nuclear have been quite heated, and now it's not part of the taxonomy. So, but what we have seen is that, if I'm not wrong, in April this year, the European Commission announced a decision to include nuclear energy in a complementary delegated act of the EU taxonomy regulation. So you see that the puzzle and the jigsaw is becoming even more complex, because there will be another delegated act dedicated to nuclear. There was also, if I'm not wrong, and if I recollect correctly, there was a technical expert group, the TAG, that was advising the European Commission on nuclear, because the problem was, okay, we agree, there is clear evidence that nuclear contributes substantially to climate mitigation. But there is also in the SFDR and in the RTS the principle of do not potentially significantly harm other environmental objectives. So that was the point, and that is the point. And So let's see what comes out. I think that the final view is that we can say that nuclear is not substantially harming, okay, other areas, and so let's see what will come out with this delegated act. It's an important piece that is today missing.
Yeah, I think nuclear is definitely a slightly I don't want to call it contentious, but I think a developing topic on this. And you know, to some extent, it's also the history of what happened that actually resulted in the way things have now kind of transpired. And I think we are all trying to kind of get our minds around the mix of energy that we need, and so we're going to have to sort of think about the different elements and what is that composition. And to some extent, you know, it doesn't exclude nuclear as a source. It's just it would not feed into some of the green definitions. So I think this is also quite important to differentiate the fact that one isn't excluding it. It's just a how does that then fit into this? And, you know, completely to Cristina's point, you know, that is why it was taken out of the first disclosures or first releases of what the EU taxonomy looks like, because we do need to take a bit more time. It has also been taken out of the UK green bond framework as well, so that has not been included. But I think we're also quite aware that there's, you know, a number of locations or countries that use nuclear extensively. So, you know, and one of those countries obviously is France as well. And again, nuclear has been taken out of the green OAT, but at the same time, it is still part of their mix of electricity. So I think, again, watch this space. It'll evolve over the next, you know, couple of years.
Thank you. One other question also related to climate, and you mentioned earlier, Caroline, that, you know, this is something that the world is going to have to work together on. Do you think that investors will at some stage need to compromise on returns in order to provide the sufficient levels of financing needed really for the world to achieve that global transition to a low carbon economy? Is there a balance there that we need to find?
This is such a classic. I love this question because because I think partially maybe one is in this space, one has a very specific view. So forgive me if that view is going to come out. But I do think that, you know, we talk about responsible investing and responsible returns. And, you know, just because it doesn't necessarily, I think we are not quantifying, to be honest, a lot of the benefit that happens from doing this responsibly or sustainably. And the other problem is, to some extent, that we're basing returns on quarterly results versus the sort of the tail that is required to actually get the inevitable long-term returns out of this. Now, you know, I have this come at me all the time around fiduciary responsibility, and that you can't actually pay up for a green gilt. Well, I think everyone has been stopped in their tracks. The fact that there was a 3 basis point greenium, there was 100 billion pounds of demand for a 10 billion pound transaction. So, you know, the trajectory is moving. And I think what is also very interesting is the outperformance of some of these transactions. I mean, Italy, for example, was priced at around, I don't know, 1 or 2 basis points through the conventional, but was then trading 13 basis points through the conventional. So, you know, if you're actually thinking about it on a portfolio basis and you're not necessarily a buy and hold buyer, actually you want that spread performance as well. It's also interesting that obviously a lot of the equity investors are starting to track ESG leaders and laggards, and we're starting to see the first outperformance, which again, it's not, if you treat your, you know, I always take it to a very simple example. If you treat your employees well, the chances are they're going to work harder for you, especially when you have sometimes volatility, or COVID is a classic example. And then obviously you're able to stay on the production lines, which obviously enables you to continue to have returns. So I think it's a really gray area, and how to define it is the difficulty. And the last point I make is we had a number of discussions with private equity firms. And this statement would not have been made 2 years ago when it was said to me, we do ESG because it's good for business. And, you know, I think that completely counters that. Is there actually a return element? There definitely is. It just, we need to have a longer vision or horizon of how we measure that.
Great, thank you very much. I'm conscious of time here. So I would just like to thank Caroline, Cristina, Antonis and Aaron for a super discussion. To be honest, I think we could go on for another hour. As I mentioned, more events coming up for the Leadership Forum next week. So on Monday at 12:30, we have a live interview with Luc Frieden, who is chair of the Luxembourg Chamber of Commerce. And he will be talking about how Luxembourg can be a driving force in sustainable strategies. On Tuesday at the same time, we have the legal group hosting a discussion on ESG and not only being a benefit tomorrow, but how that's impacting us today. And finally, on Wednesday evening, 6 p.m, Chambre de Commerce, it's our closing event for the forum. Another discussion on profit, planet and people, followed by drinks and nibbles. So I do hope to see you there. Thanks again to Domus and LuxDates and Delano for collaborating with us for the forum this year. And a couple of other dates for your diary. 21st of October, sustaining members of the Chamber can come to the breakfast briefing with the British Ambassador at the residence. In November, we have our popular annual personal tax event. And then in December, I'm pleased to confirm, subject to COVID restrictions, that the Christmas lunch will be back with the infamous gin bar. Events, all details for all of these events are on our website, so please do go have a look and sign up, and I look forward to seeing you all soon. So I'd like to thank you everyone once again. Thanks to all the participants who've joined, and I wish you all a very good weekend and a lovely afternoon. Thank you.